I think this is going to be a challenging time to invest, and it's going to be like that for probably multiple years. So it's very difficult. So what we're actually seeing, and I hate to say this, but it's true, what we're actually seeing is people put their money in other assets to cash flow right now. And we talked about this right before you hit record. There's a lot of investment money going into syndications because there is cash flow in the commercial space. I just said we're not seeing people buy rental properties right now. And in fact, quite the opposite. They're selling rental properties, right? And that is true. That is what's happening. But if I was a newer investor, I would be going after rental properties because of the horizon. I mean, there is no other way, in my humble opinion, to build wealth than through real estate.
Hey, Colorado, Chris Lopez here, and I have Kevin Amolsch with Pine Financial Group in the studio today. And I wanted to bring Kevin to the studio because Kevin has two very interesting perspectives. He is a savvy investor in Denver and also across the country. And also Pine Financial Group is a hard money lender group here in Colorado. And they're getting close to $1 billion in loans over their 16-year history. So I love talking to lenders because they see so much data and they see so many different opportunities that I don't see and a lot of people don't see out here. So Kevin, good morning.
Chris, I'm so happy to be here in studio with the man. Appreciate you inviting me in, man.
Thank you. Well, I'm excited for you coming down here. And I know it took us a while to get scheduled, but I'm glad we got here. I know you were one of the very first people I met when I came out here years ago with Charles Roberts and all that crew. And I know a lot of our listeners know who you are. I think some of the newer people don't, though. What is your background and how did you get into real estate and being a hard money lender?
Yeah, man, I fell in love with real estate super early. I was in the military, starting to read books, like how do I invest my money? I'm pretty frugal. So I had a little bit of a savings account. And then, I came across that purple Bible that we all have read, the Kiyosaki. So I really just fell in love with real estate. And I bought my first house. I was just turning 21 at the time. And I moved into it when I got out of the Army.
So you were house hacking before it's called house hacking.
Dude, I had roommates and I was house hacking. We were doing the BRRRR before the BRRRR. I was like, I should come up with this creative name. But yeah, then I moved out of it, moved into a second property. I actually used student loan to buy the second property because I didn't need the student loan because I had the military paying my school. But they gave me the money, so I took it and used it as a down payment, bought my second home, no money down. And that's when I saw, the appreciation, the cash flow, the tenant paying off the mortgage for you, all of the things we know that why real estate is so great. I saw it. So I really focused in on it and I started buying a house or two every month. And what I learned through that process is the financing in real estate is the deal. It's how you communicate with the seller. It's how you negotiate. It's how you structure your offer. So I started focusing on financing and here I am.
And then just that simply went from buying a few houses to having a big hard money lending group in there.
You said my quick story. So I was trying to shorten that up a little bit, but yeah, look, I got recruited to be a mortgage broker back before the 2008 crash. There was no licensing. It was truly the Wild West. So I was out there slinging loans.
Like traditional mortgages?
Traditional mortgages, yeah. And I got recruited because of the success I was having in real estate investing. That became a headache because I was hitting my head against the wall. So any lenders out there that just do conventional loans probably understand what I'm talking about. You don't have much control over your business because you're trying to underwrite to somebody else's guidelines. And look, there's no common sense in that business, frankly. So I wanted, how do I have common sense underwriting standards where I know I can keep my money safe and have control? So I started raising capital, private capital. That was 2006. And then I was loaning out other people's money through the crash in 2008. And then my partner and I separated in 2008 and I started Pine Financial.
Okay. And then now today, Pine Financial, how many loan officers do you have and kind of what's the general business look like today?
Yeah, there's 4 external loan officers. So they're out there commission only. And then there's 1 internal. So we're sort of trying out this new model of having someone in the office. So there's a total of 5 loan officers. And then we have the support team and the leadership team. So the support team is going to be like your loan processors, your underwriting, and then the servicing of the loans. And then including me, there's 3 leaders on the team. So there's 17 total on the team.
Wow. All right. So I really want to bring in here because I wanted to talk. I just wanted to pick your brain because we had a beer, I think 2 months ago. Wanted to pick your brain on the trends you're seeing. So I know you do about 20 loans a month. Typically out of those 20 loans, what's that deal look like? and we're entering into Q4 2024 right now.
Yeah, so we try to keep our loan portfolio allocation at 80% residential, 20% commercial. And what's happened over the last couple of years is the commercial loans are not paying off. It's difficult to get the funding for the refinances. So we're seeing those extended more and more and more. So we might have a 18-month loan go 3 years. It's modifying. And what that's done, Chris, is thrown the portfolio allocation out of whack because we have commercial loans going out, but not coming back in, right? So it's messing with the allocation a little bit. So what we've decided to do is pause on the commercial, and we've also paused on new construction for the same reason. It's just taking so long to get through those projects and focus highly on fix and flip and the BRRRR strategy. Although we talked right before we hit record here that we're not seeing a ton of BRRRR, but we are seeing a lot of fix and flip.
Okay. Before we get that, I got one more question on the commercial stuff. When you say commercial, what type of strategies? Is that ground up development? Is that bridge loans for multifamily? What type of commercial loans have you historically done?
Yeah, there's no money in ground up commercial right now. You could buy stuff at half the replacement cost. It's pretty easy to find that. So we're really funding more value add or repositioning. So think about, here's a very typical deal. A warehouse, maybe it's 40 or 50,000 feet warehouse. And then you divide that up into 5,000-6,000 square foot bays. That small bay product in Denver has a vacancy rate under 3%. It's like floating around 2%. Wow. So if you could chop up a larger box into small bays with, the roll up doors, they're just flying off the shelf. So we are seeing clients do that conversion. So that'd be one example, but a lot of retail and industrial, those are the two value adds that we see the most of.
Okay. Now going to fix and flips and BRRRRs, you already mentioned BRRRRs. And so I think everyone knows what BRRRR is, but it's the buy, rehab, rent, refi, and repeat. Yep. And it's always like, I think it's the strategy everyone's getting into real estate and do because in theory, hey, you can buy a distressed asset, fix it up, put a tenant in there, season it a little bit, and then pull out all your money to go recycle to buy the next property. That's like the textbook definition. And I mean, how many BRRRRs are you doing in 2024 compared to 2014?
I didn't pull the data of which ones are getting refinanced and which ones are being flipped, but I could tell you it's probably I'm guessing here, about 10% of our short-term rehab loans are BRRRR. But okay. I do want to mention this. BRRRR, the way you describe BRRRR is accurate, and there's another way to do it where you leverage up on the beginning instead of putting your cash in and trying to get it back out with a cash out refinance. An advantage to leveraging on the front end is when you do your refinance, it's a rate and term refinance. So the guidelines are a bit different, a little easier to qualify for rate and term if you're not pulling any cash out, and the interest rates are better. So if you're seriously trying to lock in the lowest interest rate for the full 30 years, this is a long-term hold, you may want to leverage up on the front side.
When you say leverage on the front side, what does that mean? Use another loan as a down payment or just putting cash in and leaving it in?
Well, I mean, this might sound self-serving, but I would say use a hard money loan that has a high leverage limit. So with Pine, it's 100% loan to cost up to 70% of the value. Right. So if you find, and we're not seeing a lot of those, we talked about that also. We're not seeing a ton of no money down transactions, but if you find a deal where you could be in it, purchase and construction at 70% or less, you could borrow both the purchase and construction. So you're putting very little of your own money in on the front end. So there's no money to pull out when you refinance. You're just refinancing the debt that's already in place.
That makes sense. And then they're going to still refinance away from the short-term hard money into long-term, but it's just rate and term versus cash out refi.
Yes.
Okay.
Now it could be a little bit more expensive. If you have the cash and you just want to put it in and pull it back out, great, because you don't have closing costs or loan costs on the front end. It's only when you refinance, right? But if you run the numbers over a long period, I think you might find the lower rate is a better option for you. So
is it easier today to BRRRR, or was it easier to BRRRR 10 years ago in 2014?
Oh gosh, what do you think?
I think I know the answer. Is a leading question for you, Kevin.
I got to tell you, Chris, I felt like I invented BRRRR. Obviously I didn't, but it felt like that. Like 2010 and 11, we were buying these things up like crazy around town. Montbello, Aurora North, we were buying these houses for $60,000, $50,000. I bought one in North Aurora on 16th, right by Fitzsimmons, for $40,000. And then we were using hard money, fixing it up, refinancing. Those Montbello homes I was all in for 80 or 90,000. It was renting for $1,200, right?
Wow.
So but that strategy was working when you bring in the private money or the hard money.
So I know you talk with a lot of investors, you have a lot of experienced investors, and you also get, new investors coming through, talking with you, and you guys do a bunch of like happy hours and some great events. When a new investor says, hey, Kevin, or hey, Pine Financial Group team, I want to BRRRR, how can I?
Well, I'd say maybe we're going to talk to someone like Chris, because you need to find great deals to BRRRR. So BRRRR, to make that work, first of all, you have to be in a neighborhood that has a good rent to value ratio, which is getting a little bit tougher in Denver, as we know. But if you can be in the good neighborhood, like Southwest Denver, for example, that might be a neighborhood I would target.
Okay.
And then you have to get a discount where you can add a lot of value. So what you want is a property that no owner occupant user, like a user buyer, will be looking at, because it's just not habitable or it's just so beat up that they're not. And that's what creates a spread between your value and your purchase price. Because you as an investor can get in and clean that up. You're not going to be living there. But when you find a property that's just a kitchen bath remodel, like so many investors are going for right now, well, now you really are competing with the owner user, right? They will look at those if it just needs to be cleaned up, right? It's habitable. So that's driving the values up on that wholesale product. So really you need to find a good neighborhood that has the ratios you're looking for and a property that needs a ton of work.
Do you feel like the BRRRR strategy is a great strategy for newer and intermediate investors to get into right now? Because I know it's very difficult. And I don't like to say never do it, but I've had extremely difficult time seeing deals myself.
Yeah.
A lot of clients I talk to, a lot of investors I talk to, it's just like, wow, it's really, really hard right now to find a good BRRRR.
Yeah, well, let's just talk through that. I think this is going to be a challenging time to invest, and it's going to be like that for probably multiple years. I don't think you're going to see a lot of home appreciation over the next several years, and we could talk a little bit more about why I think that, if you'd like. And we're not going to see very good cash flow on rental properties. Rental properties is very hard to cash flow. It looks great on paper most of the time, and you can make it look great on paper, right? But the reality is, when you have your vacancy or you have a major repair and you didn't actually put a loss reserve in place, that's going to chew through your cash flow for multiple years.
Yep.
One maintenance could do 2 or 3 years of cash flow, right? So it's very difficult. So what we're actually seeing, and I hate to say this, but it's true, what we're actually seeing is people put their money in other assets to cash flow right now. And we talked about this right before you hit record. There's a lot of investment money going into syndications because there is cash flow in the commercial space. If it's multifamily or it's a project like I just described, a 50,000 square foot warehouse, right? Those do cash flow. And if you can get enough people together and you could actually do that deal, that's where we're seeing the value.
Okay.
That doesn't help Pine Financial at all, right? And it's not sexy, and it's not what we want to hear, because we all want to build a portfolio of rental properties. I'm just saying it's a little difficult right now.
No, but that's one of the reasons why I like you on the podcast. And I've worked with Pine and, Justin Cooper and a bunch of team members for years, because like, hey, we're investors, but like, hey, here's the real deal. You don't shove the wrong product into the person because it's good for your commission or whatever it is, which right. I respect and I like. Talk to me about why you think appreciation will be flat.
Well, so home appreciation, if you look at the graph, if you look at a chart of the median home values I'm talking about macro now, in the country, there's been the appreciation rate after the COVID, whatever it is, $6.4 billion of stimulus, right? After that appreciation, it's never in the history have we seen appreciation that fast. So that's why people think that we're in a bubble, right? Now, I disagree with the bubble theory because of supply and demand. So the basic fundamentals of economics. So I don't think they're in a bubble, but I do believe affordability is an issue. And for housing to reach more of a neutral affordability, it either has to come down or we need inflation and values around us to come up to that. So what I think is real estate values will be flat because of demand isn't going to be there. So if you talk about supply and demand, I don't think there's enough demand to drive the values up. But I don't think we're going to see a drop because supply is not there either. So I think that's what's going to create the stability. And we've actually sort of started to see that already over the last 18 months or so. It's come down a little, but it's been fairly flat on the national scale.
Yeah, I know. I do have the same thoughts for Denver as well, because on the real estate's local.
Denver
same thoughts
has come
for like
down
Denver.
in value over the last couple of years.
Yeah. I mean, it went up 45% and came down 2 or 3%?
Yeah, it's pretty minor. Sure.
Yeah. But I mean, do you feel like Denver's not going to, you don't think it'll crash and it'll stay flat as well? Your same analysis for the national would a fit for the Denver metro as well?
Yes, I think so, because Denver almost mirrors the national inventory crisis. Like, I was just reading something today that we have about 11,000 units available in the Denver metro. And there's experts saying we need 15 to 30,000 more additional units, like new construction, just to hit what the need is for the current growth and where we are now. That's 2 times what's available right now. How do you do that? Where does that come from?
Do you have a magic wand?
I don't.
I know a lot of people wish they did. Going back to what you're seeing in trends, we talked commercial portfolio at Pine. We talked BRRRRs a little bit, but flips, I think that's the bread and butter and majority. Yep. Talk about the trends you're seeing in flips right now. So
there's been a pretty significant drop in, I say drop, it's actually an increase. It's a pretty significant increase on time of our loan is out. So from origination to a payoff date, we've been around 4.5 months for years and years and years. 2022, we were at 5 months, so about 150 days of a loan life. Well, from 2022 to today, it's increased over 30%, 33% increase in those 2 years of the life of loans. So what we're seeing is, loan maturities are taking longer. And the reason is that because the days on market's up, months of supply is up. We're over 3% or over 3 months of supply in Denver right now. You probably knew that. I saw in the stats last month, I think the first time in 12 years or something. Yeah. And they experts will tell you, I think I might have learned this from Lon, but it's really 4 to 5 months of supply is neutral. So we're getting like really close to a neutral market. And if it keeps going, that flips, right? Then all of a sudden it's a buyer's market. So I think, I guess that was my point. I think it is starting to soften a little bit. So you're seeing loans stay out longer than you normally have, and that's not due of construction or supply chain. That's just simply days on market. When the flipper has a project done, it's listed on MLS. It's just not selling in 4 days. Now it's selling in 30 days type. Yeah, that's exactly right. And it's interesting you say the supply, because there's potentially a new supply chain issue coming, isn't there? And that could create a big time impact. You're talking about the port strikes? Yep. Would that be the same thing we saw in COVID years ago, where it just has a huge ripple effect through supply chain and real estate materials? I assume, because the strike is very it's very localized, right? It's the certain union that controls a certain area. So I do know it's very localized, but I don't know that much about it, honestly. But what I'm hearing is it's going to have a significant impact if they can't resolve it quickly. And look, there's no mediation going on, so it's just like it's really like a stalemate. Yeah, it's not good at the moment when we're recording this podcast. All right, so I'm curious to know, like, if you've seen an increase in your internal foreclosure rate. It's my understanding that, for hard money lenders, around a 2 or 3% foreclosure rate is kind of the industry norm. First off, is that correct? Yes, I would say, I'd say 3% probably is the norm. The good hard money lenders will be a little bit closer to 2. But there's hard money lenders out there that are not checking credit. They're not verifying assets. They don't care about their borrower. All they want is a transaction, right? And I think that those default rates are a little bit higher. I mean, I wouldn't be surprised if we're looking at more of a 4 or 5% on some of those. Okay. Now for Pines, and you guys are on the good side, you do due diligence, you do real underwriting on, the asset, the borrower, and everything on there. Mm-hmm. Have you seen your internal foreclosure rate change as the market has shifted? Our foreclosure rate has actually gone down, but here's why. When the banks started to really tighten up, when you saw the interest rate hike campaign, and banks are basically, I'm out, I'm waiting, because the interest rate hiking puts a ton of pressure on banks. Yeah. So that's why Silicon Valley went down, right? So they had to meet deposit withdrawal requirements. So they were selling assets at discounts. What we saw is banks start to hoard cash instead of make loans. And so private money lending as an industry benefited hugely from that. So what we saw is a big spike in demand. And so to slow demand, there's only two ways to do it in this business. We could either increase our pricing or we have to tighten our guidelines. So those are really the only two levers that we have. Now, we've decided as a company to not increase rates. We're very proud that we've been consistent over the years. So we left rates the same and decided to change our guidelines. So we're just tightened up a little bit. We're saying no to more opportunities that don't fit, the box. And I'd like to get back to where we're a bit more aggressive, but right now we're a little tighter. And what that's created is less defaults.
Do you mind sharing what your internal portfolio foreclosure rate was and how much it's dropped the last bit?
Yeah, it's always floated around 2. I think I've popped over 2 one time in my 16 years.
Okay.
So it's 1.9, 2, somewhere in there. We're at 1.67 as of last week, which I guess that really hasn't changed much in 1 week. So about 1.67% is the default rate.
Wow, that's impressive. And so have you seen other hard money groups actually increase their rates or the origination fees for hard money loans? Has that been a common trend with what you said, banks hoarding cash and rates going up?
If you have the lenders, the high volume lenders, I'm not going to mention any names here, but if one of the high volume lenders that have like a 10% down payment requirement and they'll do 90% of your construction, the one that fits exactly in the box, that loan. Well, a lot of those lenders go to banks or aggregators, and they either sell off their loans or they draw on lines of credit from banks. So a majority of their capital is coming from institutional investments.
Okay.
And so in that scenario, when the rate environment increases, their line rate increases and they're forced to increase to their borrower. So we are seeing those lenders increase their rates. The guys like us that are more capitalized by private investors, we haven't raised rates.
Okay. Has the in the private investor space, for everything I've seen, there's not been like upward pressure from LPs in the funds saying, hey, I want a higher payout. I'm assuming you've experienced the same thing since you've not increased your rates.
Yeah, we have some investors that either won't come in because they're getting 5% or 4.5% risk free.
Yeah.
And so we're saying, okay, 8 to 10. And they're like, well, that's not a high enough spread. Or maybe they're drawing on their line. A lot of people will draw on their line of credit and then play the arbitrage game. And so those investors,
that's gotten harder.
Those investors are out, right?
Yeah.
And then we have some investors who want their money back because they're chasing a higher return. Now I've seen that backfire too, right? Because you're out there chasing 12, 13, 14%, and then you end up losing. And we talked about a deal just a minute ago where someone lost 150 grand. So that risk is out there.
Yeah.
But other than that, it's not bad, because what our investors have known is that we perform and it's very consistent. So whatever the market's doing, we've performed and we've been consistent. So that's what they appreciate.
Now, a few minutes ago, you had briefly mentioned, I want to kind of shift gears away from your Pine portfolio into just kind of what other opportunities you're seeing out there in the marketplace. And you're an investor yourself. I know you coach or have a lot of informal conversation with investors, and you also are very plugged into various masterminds and groups and all that. Like, talk more about the trends and the opportunities you're seeing where real estate investors are, investing their cash to achieve returns since the rental market has gotten tougher.
Yeah, and I think this is some of what you've experienced as well, but we're seeing it's still a seller's market rather in Denver. So,
which is crazy to think about, but it still is.
It is. And we're seeing a house sit on the market 30 days. I think it's right over 30 days on market. And people are freaking out. Like, this is normal. Well, that is normal. It's actually normal to have a marketing time longer than that. So I think we got a little spoiled, but I mean, if you're pricing your house right, it's selling. So what we're seeing is people cash in on their equity. Return on equity is not great right now, especially after all the appreciation we experienced since 2020. So people are cashing in and either rolling in a 1031 into a syndication type product or private lending. I mean, we've gotten a lot of new investors because of that.
Because they're looking for cash flow, right?
They would rather have the cash flow.
Yeah.
And as they get closer to retirement, I mean, it's something that you can count on. Sometimes is a little bit more comfortable.
Yeah. And also you're not dealing with tenants and toilets and the typical stuff.
That's right.
So in terms of like your own like personal investing, what deals have you recently done, or where is Kevin, being opportunistic with your investment funds? Your personal
my
investment
personal
funds.
funds. So
Yeah.
it's
Separating you
interesting.
from Pine.
Funny story here. I didn't even think we were going to get to this, but it's funny. I'm laughing and I shouldn't be actually. I purchased a note. I had an attorney call me and said, "Hey, I got a defaulted note. This lady hasn't paid on this note for 11 years, Chris." And totally taking advantage of this poor couple. Well, the second of the two passed, and so it went into the estate, and the heirs were like, "We got to get rid of this note, but we don't know what to do with it. This is an old family friend." I'm doing air quotes. And they haven't made a payment on their loan for 11 years. Yet the family, the estate, was making all the insurance payments, all the tax payments. So they didn't know what to do. This is over in Aurora, another one in Aurora North. And so I bought the note for 190 grand. And I've learned a lot through this process because I didn't know that there was a statute on how much time you can collect on the principal and interest. So it's 6 years in Colorado.
Okay.
So after 6 years, it's uncollectible. She ended up getting a very competent free attorney, and the attorney helped negotiate that. And so there's nothing really we could do, but I still worked out an arrangement with her where, hey, let's get the note performing. We'll forgive all of that. That's fine. I'll let you stay in the house, give you 6 months to get your feet under you, and then we need to start making payments. And she agreed not to contest the foreclosure if we agreed to that. And we negotiated this in the courtroom. Well, she ended up defaulting. She wants the house for free. So then she sued me, sued my attorney, sued the state of Colorado.
Oh, wow.
Sued the county, sued the judge that granted the foreclosure. So that obviously didn't go over very well. All of that got thrown out, and now we got through the foreclosure, and we're actually doing an eviction on her next week. So I'm actually not looking forward to that at all. That's sad. I hope she gets the point and moves out.
Yeah.
But I think she thinks she deserves that house for free. So that's one example, but I just closed on an office building for Pine Financial, 24,000 feet over in Kincarl.
Is that more for the business or because it's a great investment or
good question.
Best of both worlds?
It's the best of both worlds. What I found in the office space, if anyone's listening interested in office, this is something that I learned. If you're under 10,000 feet, that's all going owner user. So now you qualify for SBA. So those price per foot, you're looking at over $200 a foot. Not uncommon to see $250 to $260 a foot for that product. But I wanted to buy an office building for Pine because I think that you could get discounts right now, and I think it would be both a good investment for me and give Pine the flexibility to grow, so we could expand or contract based on our needs. But once I started looking at over 20,000 feet, now all of a sudden those are investor buyers, not owner user buyers. And the price per foot dropped in half.
Really?
And so we could buy in-place cap rates of 7. I bought this one at a 7.2 in place with a 30% vacancy. When we move Pine into it, it's going to be over 9. It's going to be close to a 10 cap. So I think just us moving in and signing that lease and that value add made it worth it. Now, was it a home run deal? No, but it's definitely cash flow, and it definitely helps Pine, gives it the flexibility.
Well, even if you're at a 7-10% cap rate, that's stellar
in
right
place,
now.
Yeah, in place. And the reason for that is because banks don't want office, right?
Yeah.
So you got to be able to qualify and get that loan to make this work. But as long as you can, it's not hard to find those type of cap rates in that space. Yeah,
I've heard some stories, especially some of these these big buildings in DTC that have sold for well below reconstruction
that's
costs.
A whole different world.
That's okay. So that's a total different world. So did you buy below reconstruction cost or?
Yep.
Wow.
So the replacement cost is about 4.5, according to the appraiser. I don't know if that's accurate, but typically their numbers are pretty close. And we bought it at 3.1. And we got a little bit of discounts here and there. We got a little credit. We got an owner carry, so they're helping me. That helped reduce the down payment requirement. And then my wife is actually an agent, so she took a commission on it. So there was another a little over 60 grand of commission. So I guess we're closer to 3 million.
Wow, those are pretty good numbers.
Wasn't so bad.
Yeah. When's the office warming party?
We're gonna have to invite you over, man. It's one other thing on that one. Wells Fargo's the anchor tenant, so we got a really solid tenant. So that should add. You would think that would push the cap rates up. But anyway, so we're working on the design right now. We're hoping to have the construction started by the end of the year. I know it's going to take a little bit of a slow process, and we'll definitely be in before the snow melts.
And this is for the tenant improvements to your office suite or Pine's office suite?
That's right.
Okay.
Yeah, we got to negotiate one tenant. Sounds like it's going to be pretty easy to get them out. We were hoping to move them somewhere else in the building. I was going to cut them a great deal to move to one of the vacant units, like discount the rent. But I think they want to just move out.
Okay. Well, hey, you found the win-win.
That's
So I got some strategic questions here for you. So, I talk to a lot of investors, like you talk to a lot of investors. If there's a newer investor, someone like you or me, 10, 20 years ago, younger, more time, less money, less gray hairs type coming in the market, like what opportunities do you see for that newer investor avatar in Denver and kind of in the current market cycle with next, couple years of flat appreciation and tough times?
Yeah, look, I just said we're not seeing people buy rental properties right now. And in fact, quite the opposite. They're selling rental properties, right? And that is true. That is what's happening. But if I was a newer investor, I would be going after rental properties because of the horizon. I mean, there is no other way, in my humble opinion, to build wealth than through real estate.
Yeah.
Now, you could be a private lender and make great cash flow. And as you get close to retirement, maybe that's a good option for you. But as you're trying to grow, I don't think that there's a better investment, honestly. So I would look at more creative type strategies. I think subject to land contracts, lease options, any of those types of strategies where you could potentially take over someone's low 3% interest rate and take on the project. I think that's where I would be looking. That's how I got started in it, and it worked really well. So that's what I would do.
Okay. What about, I know we kind of touched on, but get a little more detail on here for the investor with 10, 20 plus years experience, 3 to 10 rental properties. What type of opportunities or advice would you plant in their ear?
Yeah, so it sounds like you're talking about you and I.
Yes. Tell me what to do.
I would, I'm not doing this, so I guess do as I say, not necessarily as I do. Look, Pine Financial is my focus in this office building now, and I want more commercial assets, but my focus isn't where my answer is going to come from. So if I had more time, more focus, I would probably start liquidating residential, because I do believe it's a good time to do that if you have some equity in it, and then roll that 1031 into some cash flowing assets. You could still find, as we just talked about with this office, you could still find cash flowing assets in the commercial space. And those tenants are easier to manage. I mean, office is not triple net, right? Triple net meaning you don't have any expense or anything. But the retail is, and so is industrial. So you could roll money into a triple net deal and kind of take a breath, take a step back. It's very much easier to manage than tenants' toilets and tantrums.
Yeah. Do you talked about, hey, people could, sell 1031 into an office. I mean, what would you say? Because I have fears of office in the long run. Like, is it going to bounce back? I'm like, I don't know. Like, I gotta see. You think office is a good long-term investment? I
shouldn't say that, man. I was just saying cash flow.
Or you're saying more commercial in general.
Yeah, I mean, if you have an office building where you have a demand for it, like this building was good because I have a dentist in there, so that's a high TI package, right? Dentists don't just move out.
Oh yeah, no.
And then Wells Fargo, and they just put a bunch of money into the rebranding. So they're going from that yellow to the white or whatever, but they just put a bunch of money into their suite. They're not going anywhere. So that felt good to me. I don't know that I would just go out there and start scooping up office buildings.
Okay. Let me ask you this. Totally kind of, you mentioned triple net. And so I've never invested in triple net property. I've looked at a whole bunch, but I've always, I get very wary of it because I'm like, well, it's a single tenant office building. I know a lot of times you with a 5 to 20 year lease on there, but I get very scared. What happens if that tenant or the tenant's corporation goes out of business, or they can't pay the bills? I get terrified about having a single tenant, be all or nothing when it comes to building. Have you invested in triple nets?
No, I don't have any triple net. Well, actually, I shouldn't say that. I'm a half owner of a warehouse that is occupied by Goodyear. So Goodyear is the single tenant in this, and they're a triple net. So I do have the one. Look, triple net doesn't mean single tenant. Those are two different things. A triple net is a type of lease. All that means is it's a net. You hear absolute net also. It basically means the same thing. it's a net number to the owner. So if you say it's $15 a foot triple net, that's $15 to the bottom line. Right now, there's maybe reserves for loss management. You might have some overhead like your accounting and your tax prep and all that, but you don't have any maintenance or taxes or insurance. You don't have any of those expenses. All of that gets billed to the tenant. They take care of all of that. So you don't get the calls for any of the maintenance stuff. Now, if I go to my example of the 50,000 square foot warehouse, you might have 10 5,000 square foot suites, right? They can all be triple net, but now you have 10 tenants.
So you get the tenant diversification that way.
A little diversification.
So I mean, you're right about that. I mean, I guess pretty much all the triple net deals I see, and I am not an expert, and I just, as they come across my email inbox or someone is selling something, I always dig into it, right? I primarily see single tenant, so I always kind of have that in my mind with triple net properties.
Yeah, you're talking about a little out parcel, like a little
the oil change or the Starbucks or the Taco Bell or something like that.
Yeah. Well, if you have national credit, I wouldn't be worried about it honestly. So if you get like a Starbucks, that's probably the gold standard. Yeah. Right. And those still trade between 4 and 5.
I'll say their cap rates show it because
but I mean, if you get an unlevered 5 cap, I mean that's not terrible, and it's gonna, with rent escalations, and you have like pretty much a guarantee rent. Starbucks not going anywhere.
Yeah. I agree with that.
I feel like that if you're looking for very stable, steady, I still like private lending, honestly, but I think a 4 cap Starbucks isn't the worst thing in the world.
Yeah. But overall, kind of getting back, I went down a rabbit hole with you there. So thanks for taking that journey with me. But overall, you see some opportunities where, hey, if it's someone with a lot of properties, consider selling a few, liquidating, and reinvesting into better assets, better cash flow, and probably less maintenance, less stress, right?
I think that would be one way to do it. Yes.
Any other options or strategies? Because I've never been a big fan of like paying off a single family rental property. It's just the cash flow numbers aren't that great. I'm like, You can go park that in the T-bill right now and usually beat the paid off single family rental in Denver. I've just never been a big fan of paid off rental. So like I see clients do it. It's not my retirement plan. Do you see many clients do it, or is that ever your plan?
So I mentioned to you earlier that I went to this mastermind group, and I was in Minneapolis, and there's 8 of us, and these are all, I'm just going to be real transparent with you here, Chris. They're all 10 million or higher, much higher net worth. And we all,
what a room to be in.
We all sort of dissect each other's portfolios. One of the things that came out of this that is sort of a common theme is paying off rental properties, but it's not to increase cash flow or returns. It's just moving the leverage to maybe somewhere else so you can compile equity into one asset, and then you could get a line of credit on it, and then you still have access to that, and then you can go out and transact with that line. So that would be one reason you might want to pay off, so you could potentially leverage it later. But I'm in your camp. I don't think you should be paying off, even if it's 6% money or 7% money. I don't think you should be paying that off because it exposes you to potential lawsuits, because it's very transparent, and it does slow growth.
Yeah. So you were saying, I'm curious about this, the millionaire mastermind you're at. So you're saying a lot of them, sounds like their portfolios are not a lot of single family, but larger assets where they've been consolidating, and maybe they're paying off a fewer bigger assets, so they get a line of credit on those, like apartment buildings or warehouses or things like that.
That's exactly right.
That's really interesting.
But you could do it on a smaller scale. They've just graduated, right?
They're just a few levels above.
Right.
Changing gears on you here, 2023 and 2024, we have seen a lot of unfriendly legislation from Colorado towards housing providers. Do you have any thoughts or comments on there, or has that changed anything you're doing or anything that Pine is doing?
It hasn't changed anything for Pine at all. We do keep an eye on it, and my COO is an attorney, so he's keeping an eye on that. As far as my personal investments, not yet, but I have considered, and I probably should, maybe I'll talk to Eric, turning it all over to property management. So all my condos, I moved over to professional management because HOAs suck. I was having a really hard time dealing with that. And neighbors would fight, and I don't have any control. So it's like, I'll just let someone else deal with all that madness. But the single family detached stuff, I still manage myself, or my wife and I do. But it is hard to keep up with on the regulation. So it might make sense to hire professional management. So I'm considering that.
Yeah. Okay. But nothing over there, because I know a lot of that's more geared towards, rental properties. I don't think a lot of that is probably impacting anything on the fix and flip side,
It
right?
hasn't. Yeah, no, it really hasn't.
Okay. Well, that's good for your business. I want to look back around here because you had talked about, when I asked you a question about your own investing strategy, you said a lot of your time right now is with Pine, focusing on that, assuming as like the CEO, the leader on there. So it sounds like majority of your effort is into focusing on continuing to maintain and grow that business. Mm-hmm. That's where your active or majority of your bandwidth is going right now to continue to grow it.
Right.
Have you ever hit points where it's like, I've hit this point, in various on over the years is, hey, either investments or the business gets more attention. It's always that way. Like something always has to get the majority of your attention. How do you balance that? And how do you pick and choose?
So I think you just prioritize. I mean, I sort of think it's just time management 101, right? What's the higher priority? So for me right now, I mean, each individual task, each individual task could be different. Like you might need to it might jump into priority, like this eviction, for example. I have the sheriff lined up, right? I have to be there for that.
Yeah.
So that's going to take a priority over Pine. But in a more global view, Pine's what generates the income for me. So if there's something I could do to help Pine reach its goal, that's where my focus is.
Yeah. So I'll throw this out there. I don't know if you're ever looking for anyone to come work with you or need interns or vendors or contractors, but I get all the people ask me, they want to, get into real estate, not just as an investor, but a career. What are their goals? And is there any type of roles or people you're looking for that may fit within your vision?
Oh, that's interesting. I did just mentor this college kid. He was great. He's out on the East Coast and he came in through my EO group. Are you familiar with EO? EO. Entrepreneurs Organization. So
yes.
Anybody that's interested in, it owns a business and is interested in networking and masterminding with other business owners, unrelated business owners, EO is a great option for you. Well, one of my EO members asked me to mentor this kid and he was amazing. And so he shadowed me for an entire day. And we were out there talking to private investors. I was out there touring office buildings. And I think there might be some opportunity there. But as far as taking on an intern or an employee to help with the mentorship, that's just not something that we're set up to do.
But the mentorship side, I mean, do you need loan officers, loan processors, or anything like that? Or
the way we do this is you hire and then you want to see your return on your investment, right?
Yeah.
So now I'm looking at it from an ownership perspective here. So I hire somebody, I want to see them producing income for the company before I move to the next hire.
Absolutely.
It's not just hire because we think we could use it, right? And so it does at times push the team to the limit because they're really working hard to hit a demand. Like we have some high volume. So there is that downside, but we're not seeing the return on investment of the last hires for us to even consider the next move.
Okay. So you're still growing into what you have and filling up the bandwidth of everyone?
That's right.
Okay. So I know as you wrap up here, we're recording this in early October, and I forget the exact date, but sometime in early November, the next Investor Success Summit is happening. And this is an all-day real estate event that I know Pine Financial is putting on for years, maybe a decade now. And you do it in Denver or downtown Denver. Can you give everyone just a quick overview about the event and what the ISS is?
Yeah, thanks, Chris. And we really want to work with you on this again. But once a year, it still is the largest real estate investor conference in the state. So we'll get somewhere 300 to 400 real estate investors in one spot. And there's a bunch of vendors. So you have a whole vendor hall where you can get around and meet some of the people that are out there supporting real estate investors. And then in the beginning of the day, we'll open up with a keynote. This is going to be an interesting year because it's not actually a keynote. I'm going to do a little 20-minute intro. And then just a piece of a keynote I've done before. And then we're going to do a fireside chat with the CEO of BRRRR. So Scott, I've known Scott for several years and he's agreed kindly to join us and he'll sit up there and do a fireside with me.
Oh, that'd be great.
And then after that, we'll just do breakout sessions. So you choose which speaker you want to listen to every hour for the rest of the day. And then we get back together again at the end for a panel. We have 2 panels on the schedule this year. One is a fix and flip panel, always super popular. And then we have an insurance panel because insurance is the number one friction point that I'm seeing, especially with the higher end investments. It's just premiums are going through the roof. And I think that there's ways that you could save some money. So we're bringing in some experts and we're going to try to help people manage their insurance. So those are the two panels. I don't know which one will be at the end of the day. Probably the fix and flip, because that'll be a better draw. Insurance is kind of boring. But after that, then it's just a happy hour. We get together and have some drinks and mingle. And so November 9th.
November 9th, and it's DenverISS.com is the website, right?
DenverISS.com. And look, we don't make any money from this. You know that. It's a break even for us, $39. So we're just trying to cover the cost of the room.
Yeah. Well, if anyone has a chance to go to it, I highly recommend it. I've been there many times over the years, and it's great networking and also great learning as well. We'll, of course, link to anything in the show notes. Kevin, if people want to, learn about Pine Financial either as, hey, they need a hard money loan, or they're interested in being a private investor to kind of just get some, easy and stress-free cash flow, what's the best way to learn about it and talk with you or whatever team member is the best point of contact?
Yeah, I'm going to give you actually two here, because one I think is important. We're in some shaky economic times, and everyone, I get asked all the time, Chris, and you probably get the same question. Do you get the question, is this like 2008? Are we in a bubble? Is this going to crash?
I get it all the time.
All the time, right? So I was like, well, let me look at this, what's going on now, to 2008. And it's not similar at all. So let's go back through the recessions. First of all, it's hard to find a recession that impacted housing, by the way. But if you go all the way back to 1990, that was the last one that really had an impact on housing values. So I dissected that recession and tried to compare it to what we're seeing today to see if we could learn something so we could see what's going forward. History doesn't necessarily mean it's going to happen, but it does rhyme, as they say, right? So I wrote a report that dissected that compared to where we are today. And so you can get that report and the private lending report at thepinereport.com. Thepinereport.com. Yeah. Otherwise, you could just reach out to us at pinefinancialgroup.com.
Okay. And the Pine Financial Group, that's more of your client facing for investors that need money to do a project, right?
Either way, I mean, once you get that website, it'll take you to one of two spots. You want to invest passively, or you're out there fixing and flipping. So you'll just pick which route. And then the Pine Report is just a free report. It's not really like,
I want to read that now. I'm curious to hear because I don't know much about the 1990 recession.
Yeah, it's coming out of the savings and loans. Remember the high interest rates, high inflation. So it's
vaguely
a little similar.
Yeah. Well, cool. Kevin, this has been an absolute pleasure. Thank you. We'll have to have you back on here again to keep talking about trends, opportunities, and what you're seeing around the market and also within your own portfolio. So thank you so much.
Chris, I really appreciate coming in. You have a fantastic space. I had a lot of fun.
Cool. Well, maybe we'll do it later in the day so we can get into the liquor cabinet up there too, to even get a little more fun stories.
I mean, I come in here and I see this up here and I'm like, dude, you invited me over here at 10 a.m. and next time, 4 o'clock.
Next time we'll do it later in the day. Cool. Well, Kevin, thanks again so much. If you have any questions, definitely reach out to Kevin and his team. If you get the opportunity, definitely check out the Denver Investor Success Summit coming up November 9th. Thanks again, Kevin.
All right, Chris. Appreciate it.